Hey, I'm Abe, and today we're going to be talking about not just the down payments that we talked about previously, but the mortgages from a pretty high level. Depending on how and where you search, you'll see that people define and break down mortgage types in a variety of different ways. Some will say there's 8 different types, some will say there's 3 or 5, some are looking at government programs, some are looking at the durations of them. I want to look at it from the standpoint of whether it has a fixed or a adjustable interest rate. And then from there, we look at the durations of them. Because for the most part, those of us who are putting down payments of 3.5% know that we're going to be working with an FHA loan and that department's requirements of mortgage insurance and all of that. A lot of that stuff we talked about in the down payment video prior to this one. So looking forward, you have fixed and adjustable rate interest loans. What does that mean? That means that when you get a mortgage, you're essentially borrowing a large sum of money for the purpose of buying a home or a property. And if you had all the money necessary to purchase that, you obviously wouldn't need a mortgage or a loan to do it. So you're taking on debt to fill that gap between what you could come up with for your down payment and the final value of the house, right? So that debt has an interest rate associated with it, or a cost to that debt. And simply put, fixed rate loans at the beginning of your mortgage, you will get an interest rate, and that interest rate will hold steady through the entirety of your mortgage, regardless of how long it lasts. Adjustable rate loans means that after a given period of time, the interest rate will stop being fixed and it will start to fluctuate as the market's interest rates fluctuate. Also, generally speaking, there will be a cap with some banks. Some banks won't do this, so it's something to pay attention to and to look out for, but some banks will put a cap on how much greater or higher the interest rate can get from the initial rate that you signed on at. If you like what I'm doing, I'm just jumping in here. Go ahead and hit subscribe. If you are learning something, that's fantastic. If you would like to learn something that you haven't heard yet, by all means hit me up in the comments, ring that notification bell, and we'll get right back to it. Adjustable rate mortgages, or ARMs as they're referred to, come in a variety of different flavors, and by flavors I mean duration. Fixed rate loans, with their locked down interest rate that holds for however long the mortgage will last, have a period or a duration of that loan, right? And the standards are like 10 years, 15 years, 20 years, or 30. 30 is kind of the biggest, most, at least in my world and in my sphere, it is sort of the most standard version. Because you're paying off this large sum over the course of 30 years, the payments are going to be a little bit more manageable. But that's it. So 10-year, 15-year, 20-year, and 30-year. Now, adjustable rate mortgages, or ARMs, are usually fixed for a short period of time, and then they start to fluctuate like we talked about initially. And you might see 3, 5, 7, 10, or 15-year ARMs. And they'll be in a terminology that is a little bit different. So instead of a 30-year fixed rate mortgage, you will see a 5-1 ARM. Now that 5-1 ARM, what that means is for 5 years, your interest rate will be locked. And then every year from then on until the end of the entirety of the loan, and again, it may be 10, 15, 20, or 30 years that the overall loan lasts for. But the 5-1, the 1 in that is how frequently the interest rate will adjust. So a 5-1 ARM, locked for 5 years, and then it adjusts every year, once a year, for the remainder of that loan. And that's the same thing as a 10-year ARM, or a 10-1 ARM, for example. And you may have things where you see something like a 5-5 ARM, which means it's locked for 5 years, and then every 5 years after that is when it actually adjusts. If it has a cap, like we mentioned before, that means that if you land yourself a 5-1 ARM at 4%, that for the first 5 years, you're paying 4% interest on the loan amount. And then after that first 5 years, the loan adjusts to match the market. Now, what happens if the market interest rates have soared because whatever, the market has gone wild. And now interest rates are 15%. Like there's been a huge inflation spike, and now, you could be in a position where you would have had to pay 15% interest on this loan that you took out back when interest rates were very low, and those mortgage payments seemed reasonable and manageable. But because there was a 5% cap, that means that no matter how high that interest rate got, that your specific loan's interest rate capped at 9%. That there's only a 5% travel allowed. You started at 4, it can only go as high as 9. At least that gives you the ability to see if things really get dirty, that you'll need to cover the mortgage payments of a 9% interest loan at the worst. May not happen, but it may, and this allows you to plan for it. So if you're looking at adjustable rate mortgages, a lot of the costs are going to be lower because it behooves the bank to have that happen. If they lock you in, like right now, interest rates are incredibly low. They're about as low as they will ever be. And so banks are securing people in these loans. And from the bank standpoint, if interest rates go way up, now they've loaned you money for incredibly cheap compared to what the market would allow them to do it at this point. It behooves them to allow it to fluctuate. And because there is an inherent risk in that, and because it benefits the bank, they can make it a little bit cheaper to make it more attractive to you. Now, should you go with an ARM? Should you go with fixed? That's up to you. And the things that would dictate to you whether one is more attractive to you than another is your risk aversion and your time horizon. If you think you're going to sell your house within 10 years and you get a 10-1 ARM that's far cheaper than a 30-year fixed rate mortgage, by all means, get in there and get that mortgage. Right? Get that adjustable rate, because in the time period that you are looking forward at, you're safe. And you're going to get out from underneath that mortgage in the next 10 years. Then there's no reason why you shouldn't save $500 a month, $1,000 a month. It depends on how big your mortgage is, but like you can save a significant amount of money if you go with an adjustable rate mortgage. And if your time horizon and your risk aversion allows you to do that, then you should take those into consideration when figuring out what type of mortgage to pick. Now, if time horizon and risk aversion sound like a familiar refrain for me, that's because it is a familiar refrain. This is a large investment and possibly one of the largest investments or largest single investments that you will make in your life. And so, of course, you should be thinking about how comfortable you are with the amount of risk involved in investing in real estate, in investing this particular real estate, picking this mortgage, how long you think you're going to be in this house, how long you think you can make the payments as they go along, and so on and so forth. The same thoughts and the same planning that you would put into investing, you should put into buying or renting and this decision. Thank you for being here. Hit me up with what questions you have, and I will catch you in the next video.